welcome to 15 for 15. I'm your host, John Zalkin from RKW Residential. 15 for 15 is a new and exciting video series where we interview 15 influential real estate people for 15 minutes each, where we get their perspective on what's happening in real estate during COVID-19. A little bit about RKW. RKW Residential is an award-winning third-party property management firm with over 20,000 multifamily units under management and a growing footprint spanning 6 states. RKW delivers expertise in multifamily management through its technology, marketing, and customer experience platforms. My guest today is Charles Foschini from Berkadia. Charles is a senior managing director of Berkadia, its highest production title, and one of the company's top producers nationwide. In addition to his production role, Charles co-manages the state of Florida with over 2 decades of experience structuring complex transactions. Charles and his team have been involved in the sale and financing of commercial and multifamily properties totaling approximately $20 billion. Charles, it's really great to see you, and thank you for taking the time to join me on this episode of 15 for 15. I'm looking forward to hearing your perspective on what you're seeing in the debt and equity markets and to get your thoughts on how things are going. Can you please just briefly expand on your bio, and then we'll dive right into what you're seeing in the markets.
Sure, John. Thanks for having me. Hope you and your family are safe and hunker down. And I appreciate the socially distanced interview.
Yeah.
You know, the bulk of my career has been very simple, making big loans on big buildings. And I've structured capital deals for all the asset classes with a real specialty in multifamily and commercial office buildings.
That's great. Thanks so much. So I guess let's just dive right into the big questions here, because I know you've been in this game a long time and you really have your pulse on the markets right now. So I guess let's just go top to bottom on state of capital markets, and you could run down from the agencies to the life to CMBS, the bank debt, the debt funds, to rescue capital, what you're seeing out there and what you think our audience would love to hear about today.
Sure. I'll start with the GSEs. You know, many people forget with the passage of time that Freddie Mac and Fannie Mae and FHA were really created during World War II or thereabouts, so that when soldiers came home, if they had a place to live and a stable cost of living in terms of a rent or a mortgage, they would be part of the populace and go out and do great things. And in fact, that's where the greatest generation came from. It worked really well. So it's no surprise in today's market with the pandemic that Freddie Mac and Fannie Mae continue to lend. They do, however, lend very differently than they had done even 30, 45 days before, and that continues to evolve. And a simple example is the refinance. If you're refinancing your asset today, there is a loan for you with a Freddie Mac or Fannie Mae. However, they will not provide cash out. So they will provide liquidity, but they will not return cash above the mortgage and closing costs. That's just one example. Going from there to life companies.
Let me just jump in for 1 second. Prior to the last 30 to 45 days, how many of your clients were refining with taking cash out?
You know, it really depends on the client and their goals. But if you're a syndicator and you bought a deal and have operated it well and you've created value and you don't want to sell, a cash out refinance is a tax-free transaction that people would routinely do. And then they would continue to operate the property with a new loan at a lower rate most times, and even an extended interest-only period. So that's gone away for the moment.
Gotcha. Okay, thanks. Go ahead. Sorry.
No problem. And as you take the next step into life companies have traditionally been a very stable lender. If you put a deal under application, that deal was closing unless you filed bankruptcy or had a felony arrest. That's not necessarily true today. Life companies are having the same discovery issues in terms of rent roll and people paying rents and trying to obtain value. So most of them are on the sidelines. If you take a look at the CMBS market, CMBS makes loans on real estate, but really they're looking at the forward trade, how they securitize those deals on Wall Street. With the bond markets have blown out, CMBS lenders are all but shut down. If you take a look at banks, if you listen to the president, he's saying the banks are going to continue to lend. If you listen to the bankers, they say they're going to continue to lend. That's partly true. You know, with a lot of the CARES program, the SBA, those government-backed bank loans, they're out there doing that in force, and it's a very important part of our economy. But if you take a bank that's publicly traded and they look at their share price, are going to be very reticent to make construction loans or bank loans in today's market. So the banks that are out there that may be doing loans are really more the local and community banks, and that can only service a small part of the lending need. As you expand from that to the debt funds are generally bridge lenders. They provide opportunistic capital, and you have to look at the debt funds and really get under the hood. If the debt fund can call capital the same way an equity fund can call capital, and that capital is committed, they're still going to be making loans, but they're really looking for pricing discovery. They're not necessarily sure what rate they should charge because the risks are different. If you're taking a look at a lender that is really a front for a line of credit with a major money center bank, they can't pull those lines today. They're not making loans. If you're a debt fund that is requiring on a CLO or a collateral loan obligation where they go out and securitize those loans in a secondary trade, those lenders are not out in force today. And then if you look at life companies, many of which have separate account capital, the vast majority of them are on the sidelines trying to figure out how to price a deal and where the opportunities are going to be. At this moment in time, folks don't want to make a mistake. And then the rescue capital that you mentioned, I wouldn't necessarily call that a hard money lender, but those are lenders that charge for the risk. They're out in force because if you have a refinance and you're a commercial property and you can't get a lender, or if you're hard and under contract and expected a loan that's not coming through, they may come out and provide that rescue capital. That capital might cost 7 or 8%, maybe more, but it'll allow you to get to closing until things calm down.
Wow, so the spreads have really blown out through the rescue capital on 7-8%.
Yeah, and it's not just in the rescue capital, it's counterintuitive. If you look at the Treasury that's gotten as low as 0.3 and hasn't been over 1 in some time, the agency spreads are much wider. Most lenders have floors in their deals. And so, if your all-in rate is 4%, most times in history, that would be a very favorable rate. At this point in time, a lot of buyers or borrowers are getting some sticker shock because they're expecting, based on the Treasury, the rate to be substantially lower.
Interesting. So are you starting to see some of your clients try to retrade on the purchase where they're saying, hey, before this is what I was going to pay and today this is what I can pay, or are guys just walking me? What are your clients really saying? I'd love to hear, from your perspective, just clients on the refi side, but also clients on the new purchasing or opportunistic clients who are really looking to go get out there and start placing some capital.
Yeah, sure. I mean, before the pandemic really hit us, most of my clients, in fact, most of the equity capital had much more equity raised or access to raised capital than they knew where to deploy. Cap rates were very tight. The economy's humming along, and it was hard to see how you could really get an opportunity. Right now, we're starting to see some major dislocations, and that may start to have opportunities surface. So the equity capital in the room, if they had a deal under contract, if they were ready to close, they would close, and they did perform. I was recently involved in a deal, Flats at Doral, major institutional seller related to Florida, major institutional buyer. But our loan was really rate locked, approved, and committed well before the pandemic showed up. Clients that are in the middle of a deal right now where the loan may not be committed and rate locked, and sometimes, sadly, even if it is, lenders are looking at the MAC clause where they can come in and change things because of such a huge dislocation in the capital markets. And that's putting buyers in a very precarious position. And it's very tough for anyone to advise a buyer to go hard today if they're relying on debt and don't know what the debt's going to look like. At the same time, we're at the beginning of April, sellers and landlords are currently looking at their rent rolls and seeing in real time if they're going to have the collections that they had a month ago.
Yeah, I think this week coming up is going to be one of the bigger weeks in real estate history with everyone collecting their rents the first week of the month. I think it's going to be very interesting. Talking about your clients, what are the agencies and banks? How are they working with the clients' forbearances? What are you hearing out there, and what are you seeing right now?
Yeah, so in real time, Freddie Mac and Fannie Mae, again, because of the real public purpose behind why they exist, have come out and introduced in concept a forbearance program. So if you are a borrower in good standing, meaning your mortgage is current, and they really expect that this month's mortgage to be current, within the next few days, they're going to roll out a specific program whereby you can apply for forbearance for a certain period of time, assuming that in that same period of time, you do not evict any tenants. And that'll really put a pause on the mortgage and the market to allow tenants to stay in place, which is very important for folks to have a roof over their head when they have nowhere to move. And, you know, and there's also a public purpose in not spreading the coronavirus. So in terms of keeping people sheltered in place, whether they can pay the rent or not, that's deemed to be more important at this point in time. And the landlords will benefit from that as well with the forbearance. That has not reverberated out into the banking world or the commercial mortgage world yet, and it remains to be seen if that will happen or not.
So, and what's happening with your commercial clients, guys who have bought office buildings and retail centers and their tenants aren't paying? Are the banks starting to work with them? We're hearing some rumblings that there's...
You know, it's really too early to say. If you're a commercial tenant, maybe outside of the retail space, I mean, you and I, right? We're functioning from home. It's not the same, but we're getting some work done. We're getting things done. And the ability to pay your office rent should be there. Many small and mid-sized firms have access to lines of credit to help them through the bumps, and the bump may only be 30 or 60 days. If you're a retailer, you have perhaps a very different perspective, because not only are you out of business right now, but your supply chain for inventory is disrupted. So even if you return to business in 60 days, you may not have the same access to your inventory, and you'll have to clear out the existing inventory. So the supply chain is going to be disrupted, but we have not seen commercial come to life. There's been a lot of saber rattling. Folks are looking at force majeure. Folks are looking at their business interruption insurance policies and suggesting that the pandemic should be covered. But that's really going to be tested over time and in the courts.
Well, unfortunately, 15 minutes flies by and the time flew by. I knew this was going to be a good interview, and I knew I was excited to hear what you're hearing. I'd love to have you back over the next couple of weeks. Again, I know things are changing daily and weekly, so I'd love to see the perspective from your side over the next couple of weeks, how things are changing and what the banks are doing, because I think where you stand is probably has the most information and the most knowledge out there right now on the debt and equity sides, and this was great. So, you know, I really want to just thank you for joining me today on this episode of 15 for 15. This was really, really great and really informative.
I appreciate it, and you know, usually I'm searching for capital, sometimes I'm searching for clarity, and I'd love to come back and tell you what we're finding.
Absolutely. Thanks so much. Everyone, we hope you all stay safe and practice social distancing, and make sure to wash your hands. If you have any questions or would like to find this video, please visit rkwresidential.com.